their customers that they sell to, they've also went up. So they've not got as much free capital. They don't have as much free money around. So what happens is people are tightening their belt. They're not buying the things that are nice to have. They're buying the essentials only. And then what happens, you have this domino effect where if the customer that they're selling to has a mortgage that's went up 5x, then they're not spending the way they do. They need to tighten their belt dramatically. And if they're not buying from the small, medium-sized business, then the small, medium-sized business is now not got the same level of customers, and they've also got the increased rates that they need to meet. And so what do? They think, well, can I get some borrowing to bridge the gap? Who do they go and talk to? And it's like, well, this is what I mean is now you've got the small, medium-sized business that's serving the retail customer, that's a supply chain for the big businesses. And if that link breaks, then we've got a problem. Bear in mind that 2/3 of the people that are employed with these types of small, medium-sized enterprises, and people can't get their head around the contagion. And what I said was, I wouldn't be buying a property if it wasn't income generating, and I couldn't ride the storm here, because I think the property prices are going to go down. And the reason that they're going to go down is you've got a whole batch of people that have agreed a 2-year mortgage rate at 1% in 2022. And now when they get their mortgage renewal, that interest rate's 5 and 6%, which is 500% higher than they're used to, and twice the jump in interest rate of the largest move that was ever previously made. So they're all going to get a shock when they see their mortgage renewals. So they're going to be forced to sell, and what will happen is prices will come down, because the people that could have afforded those houses previously at the 1% interest rate now can't do that, because they go to the bank and they say, well, what do we do? And this is why it's like plugging the gap. Like you go, well, why community banking? Well, it's like there is that if you can get productive loans to the right businesses that can bridge the gap, it's not just a chasm, but you've got a time bomb going off. And if you can serve those small, medium-sized enterprises, you can give them a lifeline which keeps their business alive, which can keep the employment going, that can help them navigate these tricky financial waters that we're about to go into.
You're 100% right. And one thing that's important to note as well is the regional banks in the US. First off, they're not small banks. So people think regional and they think, oh, that's not the big Goliath or anything. Yeah, but it's not community banks. So that's the first thing. So these regional banks, which have all this commercial property on its asset, effectively its loan book, it's lent for commercial property. Even if it's lent to SMEs, we've been talking about SME loans and how important they are and stuff. That is not productive lending. So what the banks were doing there and lending for commercial property isn't what banks should be doing. In fact, that should be mostly non-banks are dealing with the commercial property space, because it isn't productive lending. Now, of course, there could be an argument made as to how you can turn it into a productive loan, and oh, well, that was being used for that, and therefore it's productive in the long run. In general, if you look at the large picture, generally those loans are productive. So that should be non-banks. When I'm talking about SME lending and community banking, what I'm talking about is only productive loans, or at least almost exclusively productive lending, which is when you're lending to SMEs, not so that they can buy commercial real estate, but so that they can invest in new machinery or develop their ongoing processes or something like that, so that their business is either generating higher cash flows or it's costing less or something like that, so they can repay the loan. So really important distinction there as well. It's not just about the customer, but it's also about what that customer is using the loan for and how that can impact the market as well. Because as you are lending for commercial real estate, the commercial real estate market is being inflated with all this extra cash that is being lent, that is being created. So if you're giving that to non-banks, you're not having the creation of additional money, which means you're not getting artificial inflation, which actually comes about. If that makes sense.
Yeah, and it's about understanding the dynamics. Like, this is the thing is that if you explain to people, right, it's done this way, and here's the consequences. And when the chicken comes home to roost, right, we've got the canary in the coal mine at the minute, and for anybody that doesn't know, the canary in the coal mine used to take a canary down coal mines, and it would be a monitor of any dangerous gases. So you would find the canary would be dead, and it meant you had to get out rather than you just staying down there and not getting the warning. Well, things like real estate prices and commercial real estate prices, that's your canary in the coal mine for the economy, because you're getting to see what's going on there. And if you look at the data and look at how everything's connected, you can see the link between productive lending, non-productive lending, speculation versus growing a business, how that relates to small businesses being employers, what that generally means for supply chains. You start to see the connections in everything rather than it's just isolated. Well, why would I be worried about a commercial real estate problem in America? And it's like, well, if you think about how that might actually spill over to you. I remember the famous one. There was a famous one where there was a car manufacturer in Detroit that had to go bankrupt because there was a tsunami in Japan because they couldn't get the part to make the cars, and then the supply chain had broken, and it was the connectedness between the 2 points. So you go, well, why would that affect somewhere over here? And people don't understand the connections, and it's when you see the connections, you realise how important these connections are to uphold. And I think what we've tried to illustrate today is that you've got these smaller businesses and you have these larger businesses. They're both really important, and the larger businesses have a lifeline and an ability to survive that isn't in the same format as for small and medium-sized businesses to survive. And if there's if there's community banks that are created, you can create a lifeline for those small and medium-sized enterprises that maybe the big bank hasn't noticed, hasn't focused on, or maybe is overlooked. And it's important.
More than just a lifeline, though. Not only are you creating a lifeline, but you're also reducing the probability that lifeline will be needed, in terms of, because you're supporting SMEs and you're supporting the productive part of the economy. Ultimately, the economy is going to be healthier. So therefore, these lifelines are less required as well. Businesses are not going to be going through such a hard time because the economy is going to be in a very productive, healthy state, growing. People employed, employment goes up, inequality comes down. All these positive things are happening when you're supporting the SME space.